What's up, everyone? This is Major Tom from International Investing. Just doing my morning routine. Going to do a quick little video here because there are a lot of fundamental things that changed in the markets since the last time we did a video. Last time we did a video, SPY was sitting at like 413, 415, and we created a new tool that was able to project where the SPY was going to go based on the heavily weighted stocks inside the SPY and where their EPSs were. For those of you who don't know, I do run a hedge fund, International Investing, and we do have basically a algorithmic or quant-like view in the market. We have proprietary tools that we share for free on our website. Feel free to check that out in the comments, or sorry, the description down below. But we'll take a look firstly at these the SPY stocks right here. So this is where we get our SPY projected price. SPY projected price has gone up since the last time we had our little video on here. Last time we were projecting a 7% downside risk with all of the earnings coming up. All the tech earnings actually beat. So what happened to our projected price? Our projected price on SPY actually came up to 401.32. Current price is 412, so we're still pretty bearish on SPY. If we take a look at the website tool, this is what it looks like on the website, but I'm just going a little bit more in depth here. Now, why am I going more in depth? Because I want to show you something. Look at the earnings that are up this week, today, and next week, right? We have ExxonMobil, an oil company, and Chevron, an oil company. Pfizer, everyone knows Pfizer is not going to do well. But take a look at all of the oil and gas companies, which I feel like everyone needs to take a look at here. ExxonMobil. Move myself up to here so you can see the EPS spread. Look at this. EPS gap down, right? Let's take a look at British Petroleum. EPS gap down, right? Let's take a quick look at Chevron. I don't know what ticker it is. Let's find it. There we go. EPS gap down. I see a trend, right? I'm not bullish on these whatsoever. So this is going to affect the SPY. And unfortunately, these oil companies all report around the same time. If you take a look at Oxy as well, Oxy is also gap down. So sorry, Buffett, but I had to do it to you. Let's just take a look at that, right? We're also going to talk about some other things that we see going on. I do very well think that a SPY projected price of 401 is more in the cards now. But one thing you have to be careful of is this FRC thing. A lot of people are playing FRC off like it's no big deal, but if we take a look at it, FRC is a very big deal. The FDIC insurance said that they don't want to step in on this one, which is kind of new. They've been kind of stepping in and bailing out all these other banks, and to say that they're not stepping in on FRC is definitely a red flag in my head. Another big thing for FRC is showing the exact same signs as SVB. SVB immediately, when they started losing depositors, wanted to sell off assets at a loss. Same thing's going on with FRC. They're trying to sell over $100 billion of assets at a loss right now. And that's not looking good, excuse me, for their assets and their balance sheets. So if we take a look into FRC's financials, it doesn't even make sense for a company to come in, swoop up, and buy them out. And the share price is just plummeting. Currently, we have shares of FRC at $6.76, people. This was a bank that was trading at $120 a share. Now it's trading at $6 and something cents, and the price keeps plummeting. Eventually, this stock's going to get delisted. They can't raise any money through shares. They can't get any outside funding. No bank wants to buy them out. And why doesn't a bank want to buy them out? Let's say Citigroup offers to buy them out for free today, basically saying, hey, we're not going to give you any money for your bank, but we'll buy you out and take on all your portfolio in order to get all of those depositors. The problem is Citigroup would have to take a $30 billion loss on their books to buy out FRC. Is that worth their remaining depositors? No. So this isn't even a good acquisition anymore. This is toxic. This bank is toxic. It's a contagion. It is not contained. The FDIC is not stepping in, right? No bank wants to buy them out. The depositors are running for the hills. And they can't sell off any of their assets because they're selling $100 billion of the assets at a loss. Like, this is 100% a problem, and everyone's just ignoring it, right? So I know, bank contagion, this, bank contagion that, fear mongering this, but it's not fear mongering if it's true, right? It's not fear mongering if it's true. So keep that in the back of your head going into next week. We have another rate hike, which is going to lead to even more bank issues. Why? Because all of these banks, especially the regional ones that don't have the funding to do commodities trading, hire traders, portfolio management, all they do with all this capital is just invest it into low yield bonds, which are now upside down. If you have low yield bonds being the only thing that you invest money in at 4% return, and then all of a sudden, like 2% return, 3% return, and then all of a sudden all of the bonds go to like 4 or 5%, that's a major issue. So that's what's going on with all of these, right? We also got Meta. So we're going to bring Meta up. Look, yes, Meta beat their earnings. Yes, we were bearish on Meta. It's okay, right? So I got out of Meta right before the earnings because I was up like 60, 70% on my position, and I decided, hey, I don't want to hold this into earnings. It's not worth the risk. I ended up being very right on that judgment call, and it's one of those decisions that you just have to make as a trader. If you're not managing your positions, you're failing yourself as a trader, you're failing your portfolio as a trader. It's too easy to manage your positions. You always have to do a little review at the end of the day and say, why am I holding this? Why did I get in this play? And just be honest with yourself. I got in this play because honestly, they were cutting employees. The company didn't look that healthy. And going into earnings, I could almost guarantee you that they were going to show some kind of reduced cost, and I didn't want to, hold that downside risk. So what did I do? I just sold my position at a profit, and then I'm looking at this now, and the stock ran up 15%, right? It's a mega cap stock or a super large cap stock, and it's up 15% basically in one day. That's a red flag to me. It's up 15%, and the only reason why it's up is because they cut cost. That's it. That's the only thing that you can give me. They didn't mention anything about the metaverse. They didn't mention anything about all of these products that they've been spending tons and tons of money on with all these employees. All they mentioned was, hey, we cut employees, and now all of a sudden the money's green again. And if we take a look at the future projections, they're projecting a 2.81 next quarter. That's great, but the only reason you're projecting a 2.81 is because you cut employees. You didn't add any value to the company. The revenue's down. So is the future sustainable for Meta? I don't know. But I certainly don't think it warrants a 15% run in the short term. I certainly don't think that. And especially when market sentiment, what's our projected SPY outlook? 401, currently at 412. So this is a perfect time to long a put on Meta, in my opinion. I got in yesterday at 240. I want to show you that we did IV crush to the upside. As you can see there, we had an IV crush to the upside at like 235, but in the pre-market throughout the day, I was kind of watching the price. We kept smacking against this 240 resistance. I called this right here a 1-2 tap at the double top, and now we're looking for a sell-off, right? So if you're not in puts yet, it is not too late to get in puts. If you really want that downside risk, you can grab it. These puts are expensive. I think it was like $800, and I got in for $815 for a put. I got like a 3-week expiration on this. Again, I'm not looking to hold a put long term on Meta. Bullish long term on Meta. Take a look at their EPS, right? I'm a fundamental trader. I'm not oblivious to fundamentals, right? I don't like to go against fundamentals, and I don't like to long options. I'm longing this option because short term, this doesn't make sense, especially with all of the market sentiment that's coming up. We have FRC collapse. We have rate hikes. We have Apple earnings. We have oil and gas earnings in the post-market and pre-market today. So You might even see Meta come back down to like 228, 225 today, 230 today, and you could just exit the put and just be done with it. That's what I would love to do because I don't want to hold this over the weekend. I don't want to continuously burn my premium up. So if I can get in and out of this put today, I will. I'm being honest with you. I'm not going to be greedy with this put. I'm going to take my 20, 30, 40, 50% profit and leave. All right. Thanks for the $500. Bye-bye. Other things that I wanted to talk about. Twillo. Twillo is the biggest one right here. So Twillo is one of those plays where we've kind of alerted it a few times now. If you take a look at their past earnings, every time they report earnings, the stock gets beat down into their earnings, and then every time they report earnings, their EPS goes up, and then the stock just starts to rip, right? I'm sorry, I'm like moving myself all over the screen here, but I'm trying to show you this chart. Look, boom, earnings rip, and the stock sells off. But look at this. We're like trading against a rising support here. Boom, touches the support. Boom, touches the support. What's it going to do? I don't know. I think $52 is the bottom for Twillo. And if we take a look at their EPS, look at the rise that's going on there. They're definitely making more profitability. And if they can report anything around a 3.0 or a 0.21, they're going to be in real good shape to rip back up to the $70 level. And again, I don't like to long options, but if we take a look at the setup here, and we increase the range to allow the stock to go to $71, we can expose ourselves to $455 worth of risk, taking an in-the-money put at $52 call for May 19th, capturing that May 9th earnings, and we could potentially make 326% return if it goes to $70 a share again, which is very possible. Why? Because we had 30% runs in the last two earnings, and I think that's, again, very possible on the next one. So be on the lookout for that. A new tool that I will kind of give a little hint to that we are creating right now. We are always getting better. We're always creating more tools. I did notice something this earnings season which really caught my eye, and I want the rest of the investors out there that take trading seriously, that watch our channel, that watch my content, and that take my hedge fund and what I do seriously for the investors. I want to kind of put you onto something. And that is a new kind of style that I've adapted. And that is, we talk about earnings all the time, but we don't talk about full-on sector beats. So if we look at the forecast, remember we looked at the forecast for all the oil companies, how they're all forecasting lower EPS, lower EPS, lower EPS. That tells me that the whole sector is doing terrible. And that if Exxon and Chevron come out today and they report down earnings, I should have no fears at all that BP is going to do bad, right? Likewise, I want to show you something that I've kind of noticed. Sorry. And that's, take a look at Pepsi. Pepsi had an earnings beat this last report, right? They already reported. Coca-Cola, earnings beat this last report. They already reported. What company is like both of those? Monster. Monster is like almost exactly like both of those companies. And they report earnings on the 4th of May, which is literally next week, right? It's next Thursday. What do I think is going to happen to Monster? I think they're going to beat. You know what I mean? So that's another thing that I want to just put people onto is that if you look at how the rest of the sector is doing, you can kind of predict where the stocks are going to go that haven't reported yet. So we're going to start creating a tool that kind of tracks that, where it's like, it groups 5 of these stocks together that are very similar. If 2 or 3 of them beat, then it could alert you to the other 2 earnings. And that would be a really useful tool. Of course, it's not always going to be right, but it's probably going to be right most of the time. And that's all we're really looking for here. So another thing that we want to look at real quick before we wrap this video up is let's go to the EPS scanner. So we're looking at valuations here. We're trying to find stocks that are a good value to us. Take a look at what stocks popped on the radar, JD and BEKE. These other stocks you've been seeing on here for a little while. We're not going to touch on those. We touched on them last video. But these two are brand new, and I do want to bring them up because they do pop on this chart quite often. What they are is they're Chinese stocks that have good earnings per share values, but get beaten down. So what do I mean by this? JD.com, take a look at it right now. We played JD.com on their last earnings pop, and this stock was selling off to right around the same level, like $32, and then right before their earnings, they ran all the way back up to $60 plus, right? You see that? They were down to like $32. They popped on our radar last time. We bought calls on this actually before the earnings, and we ended up flipping the calls at like $52. I didn't hold all the way to like 64. I'm not that much of a legend or whatever. But if we look at the last earnings, it actually, the EPS actually went down, but now the EPS is kind of trading sideways / going up, and the stock's still selling off. So that's something that kind of alerts me puts it on my fundamental radar. I don't know if JD.com is the perfect play to kind of play the earnings reversal, but it's definitely true to me that these Chinese stocks are a little, oversold again, and it's something that you all should look at. Take a look at BEKE. This one's a clear earnings beat. The forecast is significantly higher. It reported an actual of 0.19. It's got a forecast for 0.23. That's a significantly higher forecast for earnings per share on a company like this that's only worth $15. Look at what happens with BEKE every time it sells off. Look at this. Sells off all the way down to $9. Right before earnings, we see a massive pop up in the stock because people are trying to look for the value plays, and it goes from $9 all the way to $18 in a matter of 2 weeks. So this is something that we always play. It always pops up on our radar. We're not going to miss it this time. We didn't miss it last time. We're not going to miss it this time. Put these on your watch list right now. BEKE and JD.com. Put them on your watch list, right? Here's what's probably going to happen. Here's the most likely course of action for these two stocks. Right? We're not looking to get into a position right now. We're not looking to get exposure to them right now. Why? Because what's the sentiment that's going to happen in the overall market? You're going to have SPY go down. You're going to have more earnings bring SPY down. You're going to have the rate hikes with the FOMC next Wednesday, and you're going to have potential FRC collapse, which are all bearish things. Again, our target on SPY is 401 right now. That's not good. So as the SPY is coming down, you're going to see these Chinese companies probably also come down. What that's going to leave you with is a bunch of red. There's going to be a lot of stocks in a sea of red. And these Chinese companies are going to stick out to you because they're on your watch list, and they're going to be even more of a value play. You'll see these Chinese stocks actually rise probably up our list to like the number 5, number 4 spot. If you see that happen, consider going long on calls. I know I don't preach this very often. I don't like going long on options. I like just selling puts or selling calls to take a bearish or bullish stance on the stock. That way the theta is in your side, and you have a 72% win rate instead of a 30% win rate. However, on these Chinese stocks, the value is always there. It's always locked in. This is a play that we're very, very confident on. We've made multiple times. So I personally will go long on calls on these probably in the next 2 weeks when we get closer to their earnings, so I'm not losing theta, but also because I'm going into a negative market week next week. I'm going into a negative market week probably the week after, and I don't really want to be long on too many things right now. I'm long on Costco, I'm long on Delta Airlines, and very few other tickers, but really the only things that I'm long on are things that are showing massive earning gaps for the forecasts. And if you're not looking at what companies are forecasting, you're really missing the opportunities here. Because take a look at Delta. This is going to be the last thing I touch on, I promise. So if we take a look at Delta, right? Delta's trading here at $33 a share. If we pull up the earnings, look at the gap on that. It's going from 0.3 to a 2.07. Massive upwards potential there. And the stock really hasn't moved in price yet. So we're going to start to see a slow climb in Delta. I can almost guarantee it. And if we don't see a slow climb in Delta, what's going to happen is you're going to have a massive price adjustment close to earnings. So how do you play this? Well, because earnings are so far out, what you want to do is sell puts. If you sell puts at $32, you can either sell cash secured puts, which allow you to buy a bunch of stock. But if you don't have a lot of capital to sell cash secured puts, what you could do is what I do a credit spread. So you can, if you do a credit spread, you can open as big or as small of a position as you want. If you have $100 worth of collateral, you can do a put credit spread. So you short the 32 put and you go long the 31, and then you can scale that to as many contracts as you want. So if you want a lot of risk, you can scale it to like 10 contracts. If you want a little bit of risk, you can only open one contract. It's $100 worth of collateral, and you'll make 20 something, 30 something dollars off of that trade with a 72% win rate over the course of 2 weeks, which is really, really good. It'll give you like a 22% return, 30% return in 2 weeks. Again, massive, massive earnings gap. There's no way that if the stock goes down to $20 a share, you're going to see me just load the boat on calls, because it's fundamentally almost impossible for this company to report guidance of a 2.0 from a 0.3 and watch their price go down. Right? That's not how the market works. It's not. So for those of you that know market fundamentals and know market conditions and understand how stocks move, this is the perfect play for you. So if you're looking for value, if you're looking for long-term growth, look at Delta. And that's just in 3 months. I'm not even talking about their yearly outlook, because if they end up going and hitting that next forecast, I definitely see the stock going closer to $100 by the end of the year, which would be huge. But if you're looking to get into probably the best positioned airline stock, there was a reason why Buffett was holding it out of all the other airlines. I do believe they have the biggest potential to gap EPS the highest. So that's just my outlook on Delta. Thanks for tuning in. This was another episode of International Investing. I'm your host, Major Tom, and have a great week. Peace.